Investing in a sustainable vision not only helps meet global climate goals, it also boosts economic growth and creates fairer societies. For example, introducing solar power to schools in Sudan and Tanzania saw primary school completion rates increase from less than 50% to almost 100%. And in the US, it's estimated 63 million full-time jobs depend on the quality and reliability of transport infrastructure.
Good morning, good afternoon, and good evening. I'm Keesa, and welcome to the Refinitiv Perspectives live stream. As always, we encourage you to follow Refinitiv and subscribe to the Perspectives blog newsletter. In 2020, some areas of the financial markets have seen downturns. Others have seen high volatility. But one constant across the board is increased bond market activity, especially around sustainable finance. Green bonds have been around since 2007, but they are ever more in the spotlight today. And that's because of an increased focus on climate change, the need to adapt to market conditions, and portfolio diversification as a result of the coronavirus pandemic. Now, these factors result in increased sustainable bond initiatives, and that's exactly what we're discussing today. Joining us is Leon Saunders Calvert, Head of Sustainable Investing, Lipper, and INA Insights at Refinitiv, and Sean Kitney, CEO of Climate Bonds Initiative. Thank you both for joining.
Thank you.
Thanks for having us.
Great. And to start us off, Sean, can you give us an overview of the sustainable finance landscape so far in 2020? Where are we?
Whoa, we're in boom times is the only way to put it. Look, the green bond market has just passed $1 trillion outstanding. It has continued to grow dramatically despite a collapse in March, like a lot of things collapsed in March. Last month was the largest ever month of issuance of green bonds in history. And it keeps going up. But we've seen the daughters of the green bond market use the same model, use of proceeds, reporting and transparency, boom. I mean, the social bonds market, for example, well, the European Union alone has issued 28 billion euros of these things in the last 2 months for 300 billion of orders. So that's extraordinary. Sustainability bonds, pandemic bonds, and so on. So this whole market is currently about 1.4 trillion outstanding and growing like a bullet.
Wow. And so, Leon, would love to get your take there too, particularly around any challenges to measuring sustainable finance. Specifically, how is Refinitiv overcoming these challenges?
So my take is very similar to Sean's. I mean, I think we should be very, very clear. The sustainable financing, which includes bonds, but includes loans, includes other forms of capital raising on the financial markets, is bigger than it's ever been and is growing exponentially. And indeed, whilst there's been massive growth of the social bond space, which Sean just sort of was hinting at there, and we can come back to that. I think that would be interesting to discuss. But it hasn't been at the expense of either green bonds or other forms of environmental bonds, such as climate bonds. The growth of the transition bond market, for instance, is very, very meaningful as well. And so it's very, very exciting. Now, the challenge around data in this space is essentially there's still there's very little agreement around standards as to how do you define something like a transition bond or a climate bond. Now, CBI, Sean's organization is doing great work around that. And of course, Refinitiv work very, very closely with CBI in order to capture this data. But I think it's fair to say there's still work to be done to create that level of standardization around how you describe or define and flag and tag these different types of capital issuance. Green bonds are, of course, the most mature, and there's quite a good level of agreement and standardization around what a green bond is based on the ICMA principles, which CBI help us validate, what meets that criteria. But a lot of the other types of sustainability-related bonds, including things like sustainability-linked bonds. So this isn't about what you do with use of proceeds. This is about the company who's issuing the bond needs to demonstrate that as a company they meet certain KPI targets they set themselves around sustainability in order that the coupon for the bond remains attractive, quite frankly, to investors. And those are really interesting, and there's more and more of those as well that are coming to market. So that's an interesting space too. But defining what this space looks like is not particularly easy. So what have we done about that? Look, I always I always sort of struggled, maybe a year and a half ago when I came into the role that I'm in now, struggled with this idea of, we always talk about the amount of trillions that need to be raised and invested for a sustainable future in upgrading infrastructure and investments in renewables and so on and so forth. And being able to figure out how you start to track against that, and where are we against that? What's the delta between what we have today versus what we need? I always, was very frustrated by the fact there really wasn't data that did that. So Refinitiv essentially has sort of tried to create the first attempt, the inaugural attempt, if you like, to at least identify all of the new capital that's being raised. And we do that by certainly working with CBI on identifying the green bonds, very robust around that, but also identifying any other bonds or indeed loans or other forms of capital raising, equity as well, where the use of proceeds of a particular tranche of that bond are driving sustainable outcomes. It might not be the whole bond, the bond might not be a green bond, but there may be elements of the bond where the use of proceeds are driving sustainable outcomes. And so those will count. And also then that there are certain types of companies. If you are a renewable energy company and you just issue a bond, it might not be a green bond because it might not meet the principles for a green bond. But if you're a renewable energy company, then by definition, we describe you as driving sustainable capital into the markets. And so this kind of very broad, holistic view that we've taken to identify that the total amount of capital which is sustainable is how we've tried to drive this type of understanding of the market and this transparency into the market. Now, I expect that as the definitions for things like what is a transition bond and what isn't a transition bond, what qualifies, what doesn't, same for climate bonds, et cetera, as that matures more, then we can adapt to that and we'll factor that into the criteria. But that's the approach that we've taken to overcome the limitations around standardization so far. Long-winded answer, but there you go. It gives you a good sense.
No, and that's a really key point, specifically around what would qualify a bond as being a specific type of bond. That level of transparency obviously needs to happen. And we'd love to hear about transparency and how it's working and being standardized across the region. So we're thinking about across verticals now, across types. Regionally, are we seeing any sort of answers in terms of transparency? Does one region have it figured out? And should other regions take heed to that? Sean, what do you think there?
Well, in the green bond market, we've got a pretty strong global consensus of what needs to happen. It's been articulated now in the ICMA green bond principles and social bond principles and the variations of that, daughters of the green bond market. And that basic model has been adopted by regulators, even before the ICMA green bond principles were around, but now that codifies it all around the world. In China, which was a bit messy, because there are competing regulators in China for different market segments. A couple of the regulators had things that looked a bit odd. We're still working on that. But the PBOC, the central bank, has basically got regulation which is in line with what are norms elsewhere. So in that sense, that side of it is pretty well established. The nature of reporting and transparency. Hey, there's still some rough edges to sand off, but the infrastructure is in place. Where we're going now, I think, is what Leon was alerting to, which was the assessment of bonds and finance and assets of companies, entities, whether they issue into a thematic market or not, whether they know or not. Now, that's the next thing, which of course has already been part of the ESG universe. So environmental social governance filters would look at these kinds of issues, in equities especially. But there are two developments coming together here. One is an absolute approach to what qualifies under the E label. When you're looking at climate change, you can't have best-in-class coal companies, which the Dow Jones Sustainability Index used to have. You've got to say, actually, coal has no place whatsoever in climate, which is what the European Parliament has said in relation to the EU taxonomy. So that the taxonomy work that's going on now in multiple countries around the world, led by China and Europe as the two economies that did this first, is very much based on the science. And the political economy considerations come afterwards, which means it's much easier to have a common approach globally. And then that becomes a driver for what is green going forward. And that's the big development, by the way, in this particular year. This understanding that we've got to make it easy for people. I mean, don't get me wrong, it's complicated to come up with the rule sets, but it's got to look easy. It's got to be like an electric car. It's actually quite complicated to build one. But when you get in it, all you care about is you put the key in or the card and drive off. And that's how taxonomies work. And that's what grows markets. Because if we can commoditize definitions, make them simple successfully, which is the thing we're trying to do in Europe at the moment, then this market will mushroom even faster than it's growing now, because we'll make it easy for people. Does that make sense?
Sure. In terms of making it easy for people, I think one thing that a lot of people are thinking about now is the relationship between sustainable finance and COVID-19. I know people are hearing about COVID bonds, so we can put that in context, right? And so I'm wondering, to what extent has the focus on sustainable finance changed due to the COVID-19 pandemic? And we're talking about really putting this in the context of what people are hearing about now, and that's the COVID bonds. How has the landscape changed, or how is it changing at this point? Leon, do you have thoughts on that?
I'll tell you what, Sean, I'll go first, and I can see you're eager to contribute. I'll hand over to you in a second. So look, I think I wouldn't want to say that that there's been a shift or a change, because we've just described it. I mean, the green bond market is on fire and is as robust as it's ever been, more robust than it's ever been. And Sean talked about the amount of bonds outstanding, but in terms of new proceeds that have been raised in year, you're talking nearly $500 million in terms of sustainable bonds that have been raised in year up to this point, and it will almost certainly get over $500 million by the time we get to the end of the year, $500 billion by the time we get over the end of the year. So I wouldn't want to say that there's been a shift away from something to something else, but it's certainly true, of course, that social bonds absolutely had a completely record year, and it was largely driven really by two things. First of all, COVID-19 relief bonds. The need to keep the economy going, the need to keep businesses alive was extremely important, of course, with all the macroeconomic challenges that we've already experienced off the back of the humanitarian crisis of COVID-19. And so enormous amounts of bonds which have been issued, both by companies, but also by sovereigns and supranationals. To support that, but also there's been an increase, and I think we'll continue to see this in the coming months and years, an increase in social bonds which are not directly COVID-19 related, and that actually relates to something else that we saw earlier this year, which was the whole Black Lives Matter movement and the focus on that and the importance of that, and that sort of gained a degree of focus and a desire to drive capital towards outcomes which support equality effectively, and so we've seen a growth of social bonds which are not just COVID-19 relief bonds, and I think that will continue. I think the challenge actually comes to, with the COVID-19 relief bonds, the discussion there and the controversial point there has been, obviously, you want to keep businesses alive and we want to keep businesses going. We can't afford to have an economic meltdown during the form of this crisis. But equally, you don't want to allow for too long companies which are not behaving in a sustainable manner to be financed in order to survive through COVID-19, but then continue to behave in an unsustainable manner, if that makes sense. And so figuring out how you make sure that the COVID-19 relief financing which is provided also starts to address, is either short-term in nature, or if it's longer-term in nature, starts to address the need to drive for more sustainable business practices. That's where you get that kind of interesting conflict of interest. And so, I think that dynamic's been very important to thinking about, financing and a long-term sustainable outcome to the post-COVID-19 landscape. Sean, I realize you were keen to talk there. Anything else you want to add or disagree with, quite frankly?
We're always jostling to get a word in together when we talk, which is fun, right? It's a really interesting area. The comment I didn't finish off earlier, I realized, Keesa, was entity level. So where this is all going is assessing entities. And how do we have a view on BP or Shell's 2050 net zero carbon plans? Are they actually ambitious enough? Well, it kind of depends on the industries. If you're in Telefonica in the IT industry, that's certainly not very ambitious. You can be net zero carbon in a few years. If you're in steel, it might be. So developing benchmarks for different sectors, which is relatively new, and people like Rocky Mountain Institute, Energy Transitions Commission in the UK, the World Economic Forum are looking at this now. We'll see a lot of development next year. Will help us start looking at existing companies' bond issuance programs. And that'll be the big story of next year. And that'll make the sustainability-linked loan market much easier to assess. Because the moment you're relying on a corporate promise, and it's hard to relate it back to, is it adequately ambitious? So good luck for they're great that they're doing the transparency and reporting, but we've got to go a step further. That's one point. On the COVID part, which is kind of related, there is a clear understanding amongst most policymakers now that we have to build back better. It's necessary to. I think Kristalina Georgieva, at the IMF managing director, said this, started using the term build back better early in the piece. It's not only because we have to use every crisis we have to use the old Chinese axiom, but actually this is a climate crisis. Pathogens jumping between species as a result of environmental degradation is what the IPCC Health Committee has been predicting for 30 years will lead to a century of pandemics. That's what happened, folks. We're experiencing the impact of degraded environments and the consequent problems that we have. There's going to be more of them. The only question is, can we keep it to a number that we can deal with? And when they do happen, can we deal with it fast and can we bounce back? In other words, all the things that we're learning from this year of what we've done badly, and I won't mention, I will mention the damn countries. It's Western Europe and the USA and Brazil and India. We have done it badly. Some countries like South Korea and Taiwan have done it really well. We've got to learn from this. We've got to know, what does that mean for how we construct their health system in the future to better be able to bounce back and deal with pandemics. These are climate investments, folks. They're not just health investments. The social protection measures are climate investments. So suddenly we've got a much bigger picture arising out of COVID, backed by a whole bond universe of what we have to do to make sure our societies can manage what is going to be a century of transition, and then also can reduce emissions fast to avoid extreme volatility. We've got volatility. This is going to happen. We're in a race now, according to the IPCC, to avoid extreme volatility that we may not be able to survive. And that's a lesson from the pandemic.
And I love the way that you mentioned that these things are interrelated, right? We have the health piece of it as well as the climate piece of it. You can't really separate those. And also a very key point that unfortunately, this doesn't look like it's going to be our last time dealing with pandemics. I'm wondering if we look for 2021, there have been a lot of things that have happened in 2020, obviously, everything from the US elections to dealing with COVID and the vaccine that is emerging, anticipated regulation. What can we expect to see in terms of a bright light that we may not have expected in terms of 2021? If you name something new that you think we might see that not many of us are focused on that could really change the trajectory of what we're doing here.
So Sean's offered a couple of thoughts, I think, as to the future, and I'll hand back to him in a second. But let me throw a couple more in there just to kind of keep it interesting. So the first thing is to say, I think it's very unlikely that we'll see a let up of the continued growth of the sustainable financing space. There's no reason to assume that it's going to let up. It's only likely to increase. And so expect record years next year, in addition to the record years that we saw this year, quite frankly, and that trend will increase. A couple of things. One of the things that was getting a lot of attention at the moment, and for good reason, but it's very, very tough to sort of address, is this focus on biodiversity and biodiversity risks. And it's harder to address, at least today, it's harder to address in terms of really understanding the financial sort of material impacts of biodiversity versus climate. And it's not as if climate was easy to solve, but comparatively easier. But the focus on biodiversity and the desire to want to deploy capital towards biodiversity solutions, the desire to want to do no harm, and to try and understand how companies can measure their impact and understand how they can either do no harm or do good and raise capital towards meaningful outcomes, I think will increase. And so I suspect that we'll sort of start to see things like bio bonds or some other trademark, which I won't claim for now, as to how we sort of define those things, because I just see that as the next sort of major agenda on the sort of ESG landscape, if you like. I guess the other thing is, consistent with this focus on build back better or a just recovery, as you might describe it, and consistent with this process I said of you can expect to see this grow next year. ESG and sustainable financing are becoming more and more mainstream. and they're becoming more and more mainstream, not just because everyone's becoming more morally aware, if you sort of mean. I think if we were dependent on that, this whole thing is going to fail. The reason why it's becoming more and more mainstream is because there is a greater and greater understanding in financial markets, in communities at large, but particularly in financial markets, of the risks, the financial risks, just to be clear, the economic, fiscal, financial risks of not factoring in climate change or the desire to reduce climate impact through transitioning to a low carbon economy. On a long enough time scale, those become extremely meaningful financially. They become, you're expecting to see whole carbon intensive industries decarbonize over the next 10 years as a result of, regulatory frameworks, investor pressure, consumer pressure. If you don't pay attention to that and you're not managing to that, you will very quickly become the blockbuster video tomorrow rather than the Netflix of tomorrow. And that's an economic issue. That's a financial issue. And that's the reason why I think that we're going to see this continued trend and focus is not because the fad is getting more and more sort of interesting and more people paying attention to it. It's because the fad is being realized as something which is critical to mainstream understanding of your risk exposures and your opportunities for raising capital and for deploying capital. And with that in mind, it's very difficult to see how this is not going to continue to grow the more mainstream it gets. Sean, additional thoughts?
Yes, I mean, you've got investors now, basically to a person around the world, who say it's happening, it's going to happen, and we have to prepare for it. They don't know exactly how it's going to happen, and they're mildly terrified at times. I remember there's lots of signaling now. You've got the network for greening the financial system, which is a collection of central banks and regulators around the world looking at financial stability issues arising out of climate change. 3 days after Fox called the election, the US Fed says it's going to join. I mean, folks, this is a tsunami of its own, that particular thing. And they're all looking about future regulation in this area. You've got the major economies of the world lining up with tough 2050 goals. Europe first, China, Japan, Korea, and now Biden says they're going to bring it in. Now, the truth is some of these economies don't know how they're going to get there. China's better placed than most. It's got an idea, but they're going to be asking the question, and it starts now. At the next COP, for example, all these, representing more than 50% of global GDP, about 65%, will be saying, we've got this target, we're going to get there, we're figuring it out. So that's the background. For an investor, if you're in the taxonomy, say, let's call it the shopping list of the future, this is low risk because everything in there is going to be part of a policy palette going forward. If it's not in there, you can't be sure. So we're already seeing people now actively preference investments, companies, equity bonds in the sector because they're looking for ways to stay ahead of the curve of policy action. And, a good example is electric vehicles, where everyone now believes electric vehicles will happen. And there's 1,001 stories. The question is at what point the price value proposition for the CapEx will become cheaper. It's already cheaper on OpEx for electric versus ordinary. Sometime in the next 2 years, which company is going to come out of it? These are questions, right? Who would have predicted a few years ago that Tesla would be worth more market cap than GM and Ford put together? These are the sorts of changes people want to stay ahead of. So it's an amazing time of lots of changes. And what is absolutely certain is we've only just begun to see the changes that are going to happen.
So a strong focus on staying ahead of that curve, which is a very good insight. Now we're going to open it up to questions from the audience. And we have one already. Looking ahead to the next generation of investors, do you imagine a more ethical and thoughtful approach to a portfolio? Leon, what are your thoughts there?
So look, a couple of things, and I've sort of started to touch on this, but I'll answer more directly. So first of all, yes, I think there is a generational aspect. As millennials get a hold of capital and start to, have savings and be able to save for pensions and things like that, they are asking questions of the people that manage their money, which were not asked 10 years ago of those people that manage that money, which is how can I put my money to good work, or at least how can I make sure that the savings that I have here and the investments that I have are not doing damage at the very least. And so you've got essentially both a risk and return, and also I don't know whether to use the right word, impact, but outcome, if you like, in addition to the risk and return discussion, which was always part of the discussion. It was always risk return, and now there's this other kind of ethical or outcome or impact layer, which asset managers, wealth managers now have to be able to respond to effectively, right? So there is absolutely a shift in terms of a more ethical focus of how the money is being deployed. But back to the point that I made a second ago, the reason why there is so much focus on ESG data integration, for instance, in the asset management community and the wealth management community, is because there is an understanding of the financial and fiscal implications of not factoring it in. It is a financial risk to not, and a fiduciary responsibility, if you like, that if you don't factor in these risks into any long-term, investments that you have, then you are missing out on material financial important risks, and you're missing out on the ability to understand them. Now, I always typically frame that initially on a risk basis, but actually that is also true of opportunity. You are literally missing out on the opportunity to finance, the future of the economy, right? And there are going to be people that are going to be doing that, and there's a big opportunity to drive for that, and there's alpha to be generated, and there's capital to be raised, and to win as well. And so there's the risk focus side of it, but there's also the opportunity side of it, and these are financially material issues as well as ethical issues. So with both of those things in tandem, the growth of an ethical element to investing, of ESG investing, if you like, but also a general ESG integration into mainstream investing, valuations-based investing, then you've got the recipe to really kind of catalyze this.
So we see the ethical piece as well as the financial implications, and just greater understanding of the financial materiality here, really taking shape and conspiring to build this interest here. From a U.S. and global perspective, how does Biden rejoining the Paris Agreement affect the market? So we're talking about President-elect Joe Biden here reentering the Paris Agreement. Or if we want to take that more broadly as well, we know the plan that he has around green jobs, etc. How will this impact the market, the plans, as well as what he's doing with the Paris Agreement, or what he's planning to do?
It's an important change of sentiment, and it's important confirmation of what will be an economic tsunami. So in terms of, let's call it investor belief about the future, which is the key thing here, it will have very significant, not so much an impact, because frankly, investors have been assuming it's going to happen now, but they've been just cutting US out of the game. And now US back in the game, things are going to move faster. That's really it. So it's not new in that particular sense. And, I think what's unusual about the time we're in is that we have more predictive power than ever before in the history of humanity. And some of that predictive power is in short-term stocks. But, what we've learned from ESG is that the predictive power of straightforward financial performance actually is not as good as if you bring in more data points. You need more data points to look at sustainability of returns. So, yeah, but what we actually know is that those things that are material in sentiment actually happen to coincide with better sustainable returns. Now, they may not predict whether you're going to make a killing on the stock exchange tomorrow morning, but they will give you an idea of what industries are going to rise to the tide over the next 10 years and where you should make your big bets. That's absolutely it. And essentially what we're talking about when we're talking about ESG is not what makes me feel good. It just so happens that what's likely to make you feel good is correlated with material data changes. And the Biden administration stuff just affirms that. The Trump stuff has been an anomaly.
I'll just add one more thought to that. And I agree with everything that Sean said. I think that's absolutely right. One more thought to it is one can imagine, there's been lots of talk about a carbon tax. And one of the things that a carbon tax would do is it would make very, very tangible and internalize and quantify the effects of carbon emissions onto the balance sheet of companies. And that just ensures that it's financially material. It's not just being managed by investors. It just is now financial material because it's on the balance sheet effectively. And that that might take place in terms of sort of direct implication for within individual countries, but also you can think of a sort of a border tax on carbon as well in terms of trade. We're thinking about trade that comes into a country or is exported from a country, and carbon tax being applied to those goods, if you like. And that becomes a much more realistic scenario under a Biden administration than it was prior in a Trump administration. I'm not saying it's required. I'm not suggesting. I'm not even opining too much at this stage about what's good about that and what's bad about that. There are pros and cons. But I think that kind of very tangible regulatory framework around things like a carbon tax starts to become a lot more possible, likely, realistic in a Biden administration.
So clarity there, clear regulatory framework, that is what's likely ahead of us. Last question here for both of you. Do either of you see transparency in companies' disclosures around ESG being enforced by regulation? Let's, again, take a future look at that and get your thoughts there. Sean, if you would like to kick us off.
Well, the European Union and the UK government have already announced that effectively. So, yeah, absolutely. Then they'll become the norm in multiple countries. And it'll lead, because of the demand stuff that comes as a result of being able to see what's going on, to a couple of things happening. You will see a further proliferation of instruments. You'll get an ice cream range. No longer will we just having vanilla. We'll be having green, blue, resilience, transition. We haven't talked about that. It's another session. These are flavors of ice cream, but it's all heading in the same direction. One. Two is we will see a lot more public-private cooperation to try and fill the gaps in the risk profiles, to make sure that people do invest in hydrogen, say, so that we can use that as a turnkey for other sectors. Transparency will give us clarity. It's not there, and that'll force public policy. And then finally, we'll see a lot more asset creation on the part of governments. How to create a green hydrogen industry, how to create a low carbon industry, working at the private sector. Policy settings that if you're an investor, you want to know about, because that's how you stay ahead of the wave.
Love the ice cream flavor analogy there. Leon, we'll give you the last word.
Look, completely agree. The first iteration of the company disclosures is in the form of the EU and the EU taxonomy, but that is not going to be the last. This is the beginning of the process, and it's one of the areas where I think financial markets actually quite welcome regulation. Whether they welcome every aspect of it is a different issue, but they quite welcome the idea that we can drive a degree of mandatory disclosure around this type of information because it is material to them, and they need to manage to it. And having it be optional is highly suboptimal. So it won't be. It'll be the beginning. It certainly won't be the end.
Great information here. So we're talking about a market that's a $1 trillion plus market, which it speaks a great deal to where we expect it to go in the future, to increase. One of the primary challenges here that we discussed is agreement around standardization of the bonds, but moving forward in that direction, really a strong need to gain transparency around information. That infrastructure is in place, but taxonomy is a key that we need to focus on there. And Sean, you mentioned the work led by China as well as in Europe, and having an absolute approach to what qualifies under the E label, also simplifying definitions and developing benchmarks for different sectors. So much tremendous information here. Sean, Leon, thanks so much for joining us.
Pleasure.
And thank you to our audience, as always, for joining us. If you enjoyed today's episode and would like to learn more, you can download Refinitiv's Sustainable Finance Review. It's a comprehensive look at the first 9 months of 2020 by using the link or scanning the QR code on the screen now. As always, thank you so much for joining, and be well.